Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
One in cash is having the market blow up in their face right now. Stocks are racing. I am Mike O'Connor, author of StockCheatSheets.com. And this is the Unfair Advantage podcast with my host, co-host, Local Advantage, not to be confused with the Unfair Advantage, mortgage and bond forecaster, Aaron Montel, also a Denver radio personality.
Oh, yes. A lot
you
of stuff.
sleep around. You're on a lot of radio stations there.
A lot of stuff going on over here.
No, I don't want to say that, but I've had some people who like your sexy voice. Let's just put it that way.
Okay.
I won't say what they actually said.
Oh, okay, good.
It's not appropriate for a mainstream investing crowd.
It's a family show, Mike.
Yep, that's right.
Yep.
So you can, go to my Substack blog at stockcheatsheets.com or stockcheatsheets.substack.com. Sign up. We put a lot of the data we're going to go over today in the inbox. In fact, I've already sent this data out to subscribers. You can go look for it on stockcheatsheets.com. I added a couple other things because I push stuff intraday today. The good news is this podcast, because we're dealing with relative strength trends over a kind of a weeks to months time frame, this doesn't get out of date as quickly as if we're covering just kind of market tailwind scores, which happen daily. So we try to make this one a little bit more evergreen. And, it is cocktail hour, and I have my celebratory drink in my hand. I don't want the bull to knock mine over. But we made some pretty big moves today. What do you make of today's breakout? The volume did not suck.
Which was a change from the last few days.
The last couple of days, although, quite honestly, the last 2 days compared to the previous 8, much better.
Yeah. No doubt, we saw a breakout today. I want to see it at close of market Friday. I want to see it hold.
Sure. Because AA and I, we used to do a different video blog together for almost a decade. And one of the things that we know to be true is that when you see a breakout like this, a rejected breakout is one of the most punishing moves that we get in the market. We get slapped back. But we've made several attempts at this breakout. 1, 2, 3, I'm counting, then a big intermediate correction. And while we don't have the reason I share your skepticism is that broadly we don't have the money flow this time around for this rally.
Yeah, and not to be too much of a spoiler, I know we're going to get to it, but we also don't have the IWM.
Right. Even though it's outperforming, it's not outperforming with money flow.
Yeah.
Yep. Okay. So what's driving all this? We did have a big record high today. I think we closed at our highs.
New highs, yeah, I think on the NASDAQ as well.
Yep. Over 5,300. NASDAQ up 1.3. NVIDIA almost 5%. 4 and change, right? Meme stocks, sign of the apocalypse.
Yeah.
The market apocalypse.
The meme stock thing tells me that monetary policy is not too tight.
Right.
Yeah.
Yep. People's got some money to waste.
That's right.
On following, what's his name?
The Roaring Kitty.
The Roaring Kitty.
Roaring Kitty.
So April inflation, what was the metric that came out today, if you know?
Yeah, it was the CPI, the BLS report, the Consumer Price Index,
Yep.
which was largely in line with expectations, which the magnitude of the move surprises me because it was kind of what was expected. There was one the headline reading came in a tenth lower than forecast, but only because of rounding. It was less than a tenth in actuality if you went to the next significant digit. But some of the sticky components remain. Shelter remains sticky. Both rents and owner equivalent rents remained at 0.4 for the month. Auto insurance was a big part of it. So, I mean, what's the Fed going to do about auto insurance? Nothing. So So the magnitude of the move surprised me, considering the report was very much what was expected.
I guess, though, the one thing it did was inflation is not out of control. It's more cover for the Fed. This is all about the market wants the Fed to print money. And so now, I noticed that the CME, Chicago Mercantile Exchange Fed funds predictor, or is that the CBOE?
I think it's the CME.
It's the CME. Okay.
Yeah.
70% chance of a rate cut in September.
Oh, is that what they're saying now?
Yep. It moved up quite a bit on I guess it's the lack of an upside inflation surprise after a few months of upside inflation surprises.
Yeah. I mean, I guess you see the story you want to see, though, too, because because you can look at 3 months and 6 month CPI averages, and it's not 3.2. It's, closer to 4. So
over the long run, the market reflects actual corporate earnings. Over the short term, it's a casino.
Yeah. And you're right. I pulled up the CME is saying 73%, 74% chance that we'll be below below current at September.
So that moved 4 points between my blog update intraday and into the close. So just another data point, I guess, that the big money is starting to buy, but I would say selectively, as you're about to see.
Yep.
So obviously the 10 and 2 yields all fell. We're now in the mid 4s, but are we inverted?
Yeah, still inverted. As this was as of yesterday, or the open today, so probably some change. But the 2s were trading at 473 and the 10s were at 436. So yeah, we were still inverted as of the open of the market today.
Flattening?
Maybe a little bit. Yeah, but not anything noticeable. I mean, not anything to write home about.
So for those who are less knowledgeable about kind of intra-market dynamics like that, just explain really quickly the significance between the 2 and 10 year basically interest rate on a government bond and how that can signal inflation.
Yes,
or recession, I guess.
You're supposed to get paid more to lock up your money for a longer period of time, right? So a 10-year should pay you more than a 2-year.
Right.
But when that inverts and goes the other way, it's historically been, a sign of a recession. However, it's been inverted for close to 2 years now, hasn't it? Something like that, well over a year.
Yep.
So maybe that rule is on pause, but also it's a sign of, slowing growth or no growth or absent growth.
And last week I reported on some data that troubles me at the lower end of the consumer market when you start to see personal savings rates dip into the low single digits. That always kind of front runs a recession, as do escalating credit card defaults. Now, the people with American Express Platinum cards, we don't have to worry about, but it's the Capital One, the investors with collateral or really high interest rate revolving credit, like 39%. They're starting to default to the tune where Capital One, through March, I think 5% write-off rate on bad debt. When we start to see that go up and spread into the mid-market, which it hasn't quite yet, definitely a warning of sales. I think retail sales being flat. So in other words, retail, consumer discretionary, I guess retail is performing, but it's just there's no money flow as you're going to see.
Yeah.
I'd say consumer discretionary, and we had some big bellwether stocks like Amazon and CarMax just not participating in today's rally.
I think Walmart had earnings either yesterday or today, so that would be very informative of that.
Yep.
That lower part of the consumer distribution.
And a lot of them saying, I know the Starbucks CEO after their earnings report were just talking about how people aren't buying their $7 lattes anymore. So
what's the world coming to?
Yep. So I think the consumer has been bent over at the fence post and has more than diaper rash as the result. All right. So very quickly, we're going to just show you our market numbers for those of you who are not big and knowledgeable about Cheat Sheet's proprietary metric called the Tailwind Score. We take about 10 technical factors. There's nothing secret about any of those factors. I guess what's a little secret is the way I've compiled them to create a rolled up benchmark, but I would say is used for both comparative purposes and generally to give you an idea of how safe it is to be risk on. And so our tailwind scores are affected by things that make us a little bit more cautious when you don't have big institutional money flow behind it. So one little cheat in cheat sheets is when the market feels ahead of cheat sheets, it's because money flow is not there. I value money flow and weight that accordingly. So where we're at right now would be in the 40 to 50% range for most of our market indexes, which is slightly bearish. And the reason for that, now it's not everything here, you're going to see sectors and market indexes, but I think we start with the SPY. So the SPY at 48%, we're right on the cusp of bullish. But we're not there because we only got a neutral, minus, neutral plus money flow score. So that means we're just slightly bullish on the money flow, 0.05 to 0.1 shaken money flow. To give you an idea, like a FOMO level of money flow, which is kind of institutional buying pressure. So factor 4, we use the word buying pressure or money flow interchangeably. That can drive a lot of tailwind scores. The relative strength scores, I should point out, are compared to the total broad U.S. Russell 3000 market. And they don't, so relative strength doesn't weigh quite as much into the tailwind score. I think buying pressure and then the market forecast oscillators, particularly the intermediate and the longer term market forecast oscillators, that's really where to focus. Now, when you have everything kind of running in line, a 60 to 85% tailwind score is really optimal. And that's where your research really begins. So we'll tell you it gets a pass from us above 85%, still incredibly bullish. The problem is, though, you might be nearer the end of the rally than the beginning.
Yeah.
And the one thing I would say to pay attention to is the long-term market forecast oscillator. When you have a bullish intermediate oscillator, and we now have a very bullish one, so stocks are on the run, no surprise to anyone. But something even mildly bearish on the longer-term market sentiment oscillator, which is factor number 7. When you see that, it will suppress a rally. So, weeks to months can be more like weeks. So we'll have to see. And I think as you're about to see, the best tailwind scores are either defensive, like XLV and XLB, although XLV's tailwind score isn't great. It had a big momentum factor 10 breakout day today, which means that we're definitely on the move and things could be reversing there. That's a good place to go look for reversal candidates. And XLP, of course, has been running for a while. It's now crossed into that optimally bullish threshold. Again, another defensive sector. And I guess XLF, those guys don't have to pay as high an interest rate as of today.
Yeah, I guess. Yeah.
So a little bit more of a spread on their what it costs them to borrow and what they can lend out. And of course, capital markets is a big part of the XLF, and that a lot of institutions paying commissions to get into or out of stocks over the past few months as the market has been volatile. That explains that.
Right.
And XLC, you're going to find that what's really driving that are the companies that make money on digital ad spending.
Yep.
So Facebook, Google, and the reason for that is, of course,
political spendings. Big election year coming up. I'm
Here
sure.
we go.
We can't all wait to hear about it for the next 6 months.
Man, and Russia and China are probably worth half of the profits for the XLC. So
Facebook takes rubles.
Yep. So this is the back half of the market. I would say when you don't have energy and materials in the kind of in the top echelon, and buying pressure is still okay in energy related stocks, not commodities, but energy producers. And XLB materials, that's the people that pull the things out of the ground or manufacture. They're responsible for harvesting raw materials. We're still better than not on the buying pressure side, but we're in the kind of the lower half of this. I guess there's one way to interpret it. Inflation pressure might be subsiding, but then the other half of it is, well, why aren't people buying metals or energy services? It's because there may not be as much demand for that. So there's two sides to it. And then TLT, despite the buying pressure, which is very good, does not have a trend behind it. So the leading indicators look better. Intermediate market forecast is bullish. The near term, swing trading time frame is very bullish. Money flow is very bullish. So these are the kind of, that combination of statistics, when you only have a 32% tailwind score and you look at what the lagging indicators are what's lagging, and the leading indicators are what's driving it. So relative strength doesn't look good. Long-term forecast doesn't look good, and the actual long and intermediate trends don't look good. But the leading indicators are the ones pushing. That's where you can take a shot. Now, I know you have we're definitely seeing the yield curve flattening and more people, I guess, trying to grab that 4.5% long-term interest rate while the getting's good. And of course, if the market takes a dump, you're going to see people pile into TLT as a defensive move. So it's a speculative trade when you don't have a tailwind score above 50.
Yeah. Okay.
But leading indicators can matter. Okay, so now the rest of this is that those tailwind scores tend to fluctuate day to day, week to week. And you got to check them, a few times a week to keep a beat on them. That's where we do our trading signals at cheatsheets.com. But this stuff, I think, is more sticky. They don't move. When they move, they kind of stay moving. And when they fall out of favor, they tend to stay out of favor. So this is really a place to go to build a watch list. And we actually grade things in 3 ways. No grade is when you don't make the cut. And it's usually a combination of money flow, trend, and relative strength rotation, which we'll explain as we look at these charts. But a grade A stock or ETF has to have a lot of things going for it. It has to have both the longer term trend and the intermediate trend, both flashing green. You need money flow, not just at a bullish level, but at a very bullish level. And you need relative strength, not only in the intermediate term, which we like to trade, but also in the short term, in the top half to top third of the competitive ranking. These are like students getting in a college university getting graded on a curve, but it's stocks, ETF indexes. Bs are a little bit more lax. So something becomes a B if it was an A and it's weakening, or as it's starting to build strength, it becomes a B first before it becomes an A. So you want to pay attention to not just the grade, but the relative strength trend. And I think the best way to learn it is to show it. So we'll start globally. So this is going to be a lot of major economies and regions of the globe. So the first thing that I'd point out, AA, is the SPY is not necessarily the best neighborhood right now.
No.
Now it is 7th overall out of roughly 20 global ETFs that we're checking here. So definitely in the top third overall on average in the last 3 to 6 months. But if you look toward the sweet spot, which is basically calendar 3 to 6 months or 60 to 120 days, when you see transitions that go from green on the left side to red on the right side, that would be something that's falling competitively out of favor. Prices are not keeping up with the rate of change in higher ranked indexes, right?
Right.
And then, so you look at that and money flow. So we used to see during our intermediate pullback, we were seeing, the 5th to 13th transition happening with money flow that was red, below negative 0.1. And so at least we're not under distribution anymore. So that is a change. We've kind of hit equilibrium on money flow while price performance has continued to stay behind the rest of the world. I think both of us agree that this is a rare time where other foreign banks are sensing the global slowdown and are a little ahead of the curve compared to the Fed on printing money, right? That's what this is, I think, really all about.
Yeah, they're becoming first to the trough, so to speak, right?
Yep. And then if you're a disciple of Peter Zeihan, like I am, who likes to look at demographics and geopolitical relationships, he's big into the idea that geopolitical interconnectedness is unwinding. And we're entering after 70 years, back to the more traditional model of every country for themselves. And resource-rich countries will tend to do well, or countries that have big populations that can consume a lot of stuff can do well. And the ones that have neither and are net importers with populations that are in decline, meaning it's more old people than young replacement workers. They tend to do less well. That can be inflationary and all of those things. So we're seeing here kind of maybe I would say the anticipated money printing is the bigger factor at work here.
Yeah, just a quick aside, it just dawned on me on I think this time might be different because the spread in labor costs is something we haven't seen in history before, right?
Yep. Although, and I'm assuming you mean like developed economies versus emerging.
Right.
That is starting to change, though. Like, for example, China is no longer cheap from a labor standpoint, but its GDP has been better than anyone expected.
Yeah. Yeah.
Sorry, I'm getting spam telemarketed. It's prime time for that.
Yes, it is.
So go away. All right, so let's take these in order. So Hong Kong is part of China now, rotating into favor with decent money flow. China rotating into favor through the sweet spot, nearly complete with what I'll call FOMO level money flow, grade A. We're top 50% in the sweet spot, top 33% in the shorter term, with positive money flow, and both the far right and the middle trend up. That's the way to look at a grade A. Taiwan, you kind of get the feeling Asia's in play right now.
Yeah.
As is the Eurozone, that's where Germany, EZU is kind of the collective Eurozone. So German economy looks on like it doesn't have the money flow though. Yeah. Eurozone overall has some money flow. And France, not so much either. It's the UK is not part of the Eurozone anymore. Italy, it's been pretty strong for a while. So Italy is a B because the money flow is no longer above 0.2. It's been very persistently strong, but the money flow is down from FOMO level above 0.2 to just 0.1.
Okay.
Australia, that one's interesting. That one doesn't really have the relative strength rotation, but has decent money flow. And then EFA is Europe, Far East, and Australia all combined, grade B.
It's interesting to me. It looks like SPY started to rotate out of favor just as Asia rotated in.
Yep. Asia and the some of the Eurozone.
Yeah.
Yep. I think that the international theme, which has been really badly underperforming the U.S., and listen, you print money, asset prices will go up.
Yeah.
And
it's got to go somewhere.
So we're going to be in this weird gyrational. My personal opinion is that the money printing jig is up, and there's going to be shorter cycles of hikes and loosening as they try to manage this thing. And God forbid they eventually will create hyperinflation. Hopefully, while we're not still breathing.
Right.
Yeah. And Japan, of course, after China, I'd say Japan, and then the U.S., the kings and queens of hyperinflation. Mm-hmm. Japan, despite the stock market running out of steam because it had to defend the yen, money flow is still decent there. So money flow globally outside of the U.S. pretty good.
Yep.
All right, so that's tier one, and I'm not going to over-explain the charts or how to interpret these grading system anymore. You can always go to cheatsheets.com and get the rules of engagement and all of these charts, by the way. So natural gas still really early, don't have a long-term trend yet, but got some money flow, and we're just now rotating into the sweet spot. I'm assuming it's summer. We're getting into the summer natural gas season, right?
That's
hurricanes. It's hurricanes threatening the refining and the pipelines.
That's so interesting. Yeah, I'm surprised to see natural gas doing what it's doing at this point of the year. And
twice a year there's a cycle.
And also, it's just been so hammered over the last several months that it could have just be reversion.
Yep, that's possible. Though there's always this little pre-hurricane, pre-summer season. My gas bill is a lot lower in the summer compared to my electric bill for AC, but I'm here in Texas.
Yeah.
And then, so I think there's a hurricane premium because all of the U.S. natural gas refining is right on a hurricane zone.
Okay.
Houston.
Wow.
And then, of course, it'll be hot again going into the summer heating, or just late summer, early fall before the heating season. And Canada's natural resource, that one's been cyclical. I'm gonna drop down to the grade Bs and As. So there's again, you see the IEFA. This is another European, Australia, Far East play. VEA, rest of world. Again, pretty similar theme here. Spider, developed world. That's SPDW, just above the ACWI, which is the all country world index. All of it just doing better than the US. Mm-hmm. And then it looks like besides natural gas and, listen, there is a small cap ETF, the S&P small cap. It doesn't have the money flow, but it is interesting. It's got some decent cyclical relative strength.
Got it.
Okay. So this is our macro, and it looks like it looks like we're not going to have a gas crisis this May. And there's the dollar. Okay, we've seen all that.
Barring any geopolitical.
So we've kind of been over this, but the most important thing to know is that anytime you see money flow below negative 0.1, be very skeptical of anything rallying. And if you see money flow above 0.1, especially above 0.2, anything rallying, that's a confirmation signal.
Okay.
And money flow is a combination of kind of how things finish for the day or the week, depending upon whether you're looking at daily or weekly charts, combined with volume. So big volume, highs for the day or the week, very bullish sign. Okay, money flow is something that we provide it as a snapshot, but it's also good to put it on your own chart so you can look at it as a function over time, right? Because money flow is more like pressure, the steam pressure that builds on an engine.
It helps confirm some price movements.
It does, and it's better to look at it in terms of over time, because a lot of times price will stay stagnant, but you'll see money flow build and build and build, and then relative strength will start to change. So sometimes it's little incremental differences in the delta in price that you're not picking up on the charts with your eyes, but you start to see that those two pressure points build, they're front running actual price movement, which can turn into explosion. And so we love that combination here at Cheat Sheets. All right, so relative strength. Now, so instead of being a snapshot like the earlier chart of sectors, this is about where the puck is going to be, as Wayne Gretzky would say. So utilities looks pretty persistent. It doesn't look like that's letting up anytime soon. Yield replacement, perhaps, defensive.
Yeah. It's hard for me to figure out. It seems to me like being defensive makes more sense than being a yield replacement at this point.
Tech likes lower interest rates. We've had some better performance out of tech recently, but not confirmed by money flow. And the rotation is very shallow. It's only the last 4 or 5 weeks.
Yeah.
Real estate, same thing. How's your phone at Local Advantage Mortgage?
It's still slow, still volume, but it's picking up a bit.
I think you had mentioned something interesting to me that, again, we're seeing two economies here where the low end is credit card defaults and personal savings rates not good, but that's not everybody, right? There's definitely anyone with assets is doing better.
Doing well, not even better, but doing well. Most of my business this year has been people buying second homes and investment properties.
So that's people with the wealth effect, right? That 30% stock market move last year.
Yeah, that's right.
And the recovery from a temporary bearish pullback. They're flush with cash and ready to buy investment properties, right? That's what you're financing?
Yeah, the narrative that they hear. Not saying I don't endorse this narrative, but the narrative they hear is that the Fed is going to lower rates and there's going to be a ton of competition in the real estate market and prices are just going to go sky high again. That's what they're operating under.
So XLC is this weird amalgamation of some old line communications, like I guess AT&T is no longer old line, but you still think of the people with the what's it called? I don't remember. Like the phones that are connected to a telephone pole.
Like
the wireline business, I guess it's called.
Landline.
Landline. Thank you. Thank you. Which is how most political polling gets done, by the way. Which is why it's never the reality.
So it's really reliable, is what you're saying.
Yeah. Well, I'll tell you what old people are going to show up for this. But XLC is made up of that old line, but more and more. And from a market cap perspective, Google, Facebook, and what we'll call and the streaming media companies, so new media. And all I can tell you is now my day job is still working for a digital ad agency that serves media. And our Facebook and Google prices are going up. And that's because
political dollars are coming in.
Because your mind is being manipulated.
Yeah.
I think half the money is being laundered, through proxies, but it's coming from Russia, China, and Iran. There's a lot of mind molding going on right now.
Oh yeah.
So get ready to be outraged for the next several months.
Breathe it in deep.
Yep. So XLC, obviously, FOMO level of money flow rotating back into favor after an intermediate pullback. Still a grade B because the sweet spot is all over the road. Besides that, we don't have any grades and only a few pockets of money flow besides treasuries. Really, consumer staples is the only one. So this really tells you this rally. Listen, when prices go up, they go up.
Right.
But this one is not nearly as broad-based as the one we had this winter.
Yeah.
Yeah. Okay, so we're gonna let's dive deeper now. So we took basically the top 11 sectors of the economy. So think of that pie. Think of this as the next slice where each sector gets further divided into what we'll call subsectors. Again, the same principle here. You can see some very short-term changes. But again, we don't really, anything that's, 2 or 3 look-back periods, we don't pay that much attention to. But we'll point out that XRT looks better despite the retail sales that came in today. But the money flow is not there. And the money flow is not there for regional banks or telecom, certainly not for biotech or semiconductors, which are all looking better from a rotation standpoint. Really, the midpoint of the chart, other than the fact that everything's allowed to have an off week, and we're seeing that with capital markets and aerospace. This is KCE and XAR that have been running both grade A or oil equipment services and gas equipment services. It's not doing as well lately as it has been, so only a grade B. So that's one that might be falling out of favor. And the ACWI, again, better than the SPY here. Capital markets and insurance, grade Bs. Some money flow in the lower end of things like XITK, which is tech and software and services, XSW. Not a whole lot of relative strength, but definitely where institutions are parking money.
Yep.
So these are places to remember: money flow first, relative strength transition, trend at price and trend in that order.
And for the most part, it's the same old playbook.
Yep.
Yeah.
So I like looking for grade Bs where you start to see a relative strength transition that happens in the sweet spot. That's, I think, the earliest I like to get in or start looking at stuff. Now, A's that are persistent and might have like a week or two pullback, that's another great trade. Where those are the kind that, especially when the market conditions are extremely bullish, that can run for months. We're trend followers here, and Cheat Sheets is not designed as long-term investing guidance. It's data for a weeks to months trading system where you're actively trading a portfolio, which is never going to be the big chunk of your portfolio. You have to be careful, with this stuff. There's taxes and all that. Okay, so now the thing I wanted to end with was commodities.
Okay.
And so this is, again, just a deeper look at that global macro that we showed. So we can sort of see things at a more granular level. The money flow here, just overall, even though the trends have been a little bit, any kind of intermarket data is going to be Fed dependent, right? Are we printing money or not? How are the economic circumstances matter a lot more to commodities, right? It's a little simpler to trade because of that.
Right.
There's less gamesmanship with corporate balance sheets that tends to go on.
Yeah,
right?
And buybacks, etc.
Yeah, it's like, we all need to eat, so buy corn or sell corn. When it's in your stool, I guess you're selling it.
Right.
So what do you see here? I mean, my eyes always go to where the money flow is, especially where the money flow above 0.2 is. I see wood. I see platinum, clear wheat,
some food items,
soybeans, or is that lithium? No, that's soy.
So this also tells me that the bond rally may be premature.
So some inflation.
Yeah, perhaps. I mean, If these things are expected to rise in price, which is why money would be going into them now, then the bond rally might be early.
Yep. So the stock market's generally sort of in the, I would argue, in the top third of the commodity stack here. Coffee, we got a bad data feed on coffee as far as this is JO. Sorry, down where there's an NA.
Mm-hmm.
That's under distribution. Sugar, cane, not looking spectacular. DBA, which is an amalgamation. DBE, the Dynamic Energy Fund, kind of an amalgamation. No money flow, no relative strength. Brent oil, USO. So in some ways, the stuff that people have to spend money on, to get through life, a little deflationary right now. So there's some mixed signals.
Yeah.
Industrial metals, agricultural commodities look better. I would say energy and certain. There's not a clear picture.
There's not. Also, I'd point out that some of those base metals reaccelerating are also part of that mixed picture, because those base metals are kind of pointing to growth, and which would then lead to inflation, right? If it's too soon.
Yep. So finally, before so we did subsector ETFs, and then we did commodities. I guess we got one more. Okay. So now we're going to slice the subsectors into even narrower slivers, right? This is called a top-down analysis, where now we're looking for a very specific industry group strength. And again, if your eyes go to the grade A's first, those are going to be your best bets, followed by grade B's, where the relative strength transition is positive instead of negative. And then you can look at really high money flow scores that don't yet have grades. Those are always worth a look. And then it's up to you to decide how much risk you want to take, right? The more factors in your favor, the more information you get, probably the more confidence you can have in the trade. But at the same time, the trade may not be as long lasting as when you catch one of these early indicators more early, you can get bigger gains. So there's always a trade-off between risk and reward.
Okay.
So where do your eyes go?
I went to the bottom there and I saw, natural resources.
Yeah, just a couple of bad weeks for natural resources. Trend is still good, and the money flow FOMO level.
Yeah, that's what caught my attention.
So I'd look for an intermediate pullback on ETF HAP.
Yeah,
that's probably a good play the longer term bounce or play the weekly charts.
Yeah, personally, the way I use this data is I like to see a week or two of weak data that follows several weeks of strong data, and the money flow remains.
You get a real pullback instead of just a 2 to 5 day swing trading pullback.
Yeah.
Yep. All right, so my money goes, so I'm going to save my pick for after we look at this chart. By the way, this is just to give you an idea of how many industry groups are, and I'll toggle here, but there's this many.
Oh, wow, okay.
Yep. So, and I don't know why I added PXE. I thought that was FXE, which is the Euro ETF. But so food and beverage, PBJ, consumers, they're selling that.
Okay. Interesting. I hadn't seen this slide yet. Cool.
Yep. Yeah. So there are a couple of grade Bs here. I would say the Alarian energy infrastructure. Obviously, energy is a little soft right now, but the money flow is still good.
You have also here, you have a property and casualty insurance. And I noticed that the insurance subsector was also doing well.
Yep.
So insurance seems to be doing very well. And it was also one of the items that showed up in the CPI report today is hot. So
yep.
They're clearly passing on whatever cost they have.
Yep. So there might be a little bit of an intermediate relative strength issue, but the level of money flow is FOMO. That's where you go look for good opportunities.
Got it.
I'm going to go back to the main chart, because I think, listen, I don't know that much about people watching other people play games on a social network, but I can't argue with the relative strength persistence, the money flow, the multiple trends. That's an A. ESPO. Fan, Peter Zeihan, who I'm a disciple of. He hates renewables in general because the cost of creating the renewables, when you think about the lithium that has to go into batteries and so forth, you don't get the return on it. But he is bullish on wind energy. And the reason for that is the tech has improved to the point where they can put the wind turbines high enough in the sky where the wind blows pretty much anywhere, instead of just in windy spots around the United States, which is only in the south central United States. So fan as opposed to tan. You'll see both rotating into favor, fan, wind, and then 2 slots down is tan. Solar, you'll see the smart money ain't buying the tan story, but they're buying the fan story.
It's funny, we've noticed over the years that tan and oil do this dance, right?
Yeah, that's true.
And it doesn't seem that fan has been invited to the tan oil dance. It just seems to kind of do its own thing.
It's its own thing, but I would point out we've gone from 160 days ago, the 25th ranked industry group, where we've we kind of struggled, but rotated into favor beginning at about 70 days. So this, I would say, is still an early story where trends are all rolling in your favor. The level of money flow is FOMO, and the relative strength transition has recently happened. So it's definitely worth looking at.
Got it.
And the one I'll take your eyes to as we wrap up here. Now, this is one that I think is a AA kind of, it hasn't had the pullback yet, but let's look at GRID, GRID. Number one, if you look at the average relative strength rank over the last 3 to 6 months. And then you look at the relative strength during the sweet spot, persistent. Look at the relative strength during the shorter term, definitely in the top 33%. Money flow is at a 0.61, one of the highest money flows that we see.
Wow.
With multiple trends. And that is my ETF spotlight pick to wrap up this video. So this is the first trust NASDAQ clean edge smart grid infrastructure. And all I can say about it is 3 words: Inflation Reduction Act, where there's nothing inflationary or reducing about deficit spending. But there is green stuff sloshing into this, the companies that build any kind of infrastructure related to turbine, solar, water, nuclear, you name it.
Right.
It goes here. And you can see that institutions like to chase the money. And when government funding money is sloshing in the direct money we don't have to spend, that's where it's being spent.
That's where it's going.
And the stock prices are going up.
Well.
AA, the name of your website is Local Advantage Mortgage if you're in Colorado. What we love about AA is he knows how to game the system, and he kind of he tells you a few weeks in advance whether or not to lock based on where he watches the bond market. Most mortgage traders, I can say it, you can't. They're mouth breathers. They smile and pretend they know what the fuck they're doing. AA actually is a certified market technician in training, and it's passed his first test.
Thank you for keeping that compliant.
And knows what he's been doing technical analysis for 2 decades.
You and I have been doing this together for close to 20 years, haven't we?
And where's your Substack?
Oh, it's macrotomortgage.substack.com.
So even if you're not in Colorado, and because you have to be licensed in a particular state to deal with AA, but you can always take advantage of, because where bond prices are going is not state centric.
Right.
And I'm Mike O'Connor. You can subscribe to my stock cheat sheets at Substack, or go to www.stockcheatsheets.com.
Excellent.
Thanks for watching the Unfair Advantage Investing Podcast. We'll see you again next time.
Thanks, Mike. That was fun.
All right. Now let me figure out how to turn this friggin' thing off. I don't have a nice, powerful close like I have an open. So I guess I'll just hit this button here. This button ought to do it.